Assalamu alaikum and hello everyone. In this lecture, we will focus on two important capital budget decisions. Number one is replacement analysis, and the second one is optimal capital budget. So, what is replacement analysis? It is the process of evaluating whether it's financially beneficial to replace an existing assets with a new one. The analysis involves comparing the cost and benefits of keeping the old assets versus investing in a new asset that may improve efficiency, reduce operating cost, and enhance productivity. So, the main goal is to determine if the after tax cash flows from the new machine, when discounted to present value, justify the cost of replacement. So, while solving the problem in replacement analysis, we need two things. One is after tax cash flows from the new machinery or new asset, and we convert it into the present value because we are going to take decision right now. So, present value is also required. Here we have the problem 12-4 from Fundamentals of Financial Management from Brigham Houston. Here, the company is considering the purchase of a new machine to replace an obsolete one. The old one is an obsolete machine. The machine being used for the operation has a book value as well as the market value to zero. So there's no market value because the machine is obsolete. So, however, the machine is in good working order and will last for another 10 years. So the remaining life you can say is 10 years for that machine, that old machine. And what about the new machine? The proposed replacement machine will perform the operation so much more efficiently that the company's engineer estimate that it will produce after tax cash flows of $9,000 per year. And this after tax cash flows means these are the savings from this efficient machine. These savings are in the labor cost as well as in depreciation expense. So this 9,000 is per year. The new machine will cost 40,000 delivered and installed. This means that this 40,000 is inclusive of all sort of cost at year zero, which is the acquisition cost, delivery cost, and installation cost. And the economic life is estimated to be 10 years. 10 years is the life of new machine as well as it has zero salvage value. The firm weighted average cost of capital is 10%, which we are going to use while calculating present values. And the marginal tax rate is also given, which is 35%. So, should the company buy the new machine or not? So, here it is the decision as we have discussed in the slides that we need to calculate after tax cash flow. So, after tax cash flows is given here, which is 9,000. And this is the cost of the purchasing and installation of the new machinery, which is incurred at year zero. So, for the decision that the company should buy a new machine or not, this depends on net present value. If net present values come positive, then the company should go for it. So, now we are going to calculate present values. We have years 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10 years. Then cash flows. At year zero, the company incurred 40,000 as cost. So that's why it is minus at year zero, which is 40,000. Then 9,000 is the cash inflows or after tax cash flows each year till the end of the useful life. So, which is 9,000 for 10 years because the useful life of the new machinery is 10 years. Then what we are going to do is to calculate present value factor. These present value factors are required to convert cash flows into present values. So the formula is 1 divided by 1 plus I, and this I represent rate of interest. Here we have WACC 10%, so we use it 0.1, which is 10%, and raised to power n. So in n represent the number of the years, so it is 0 years, so n is 0. And now here at year 1, n is changed from 0 to 1. At year 2, n is 2. At year 3, n is 3, 4, 5. Now we are converting, or we are calculating present value factor. So interest or I remains constant, whereas n changes as the year changes. So it is 6 at the year 6, and 7 at the year 7, and it is 8 at the year 8, and it is 9 and 10 at the year 10. So next step is to calculate uh, net present value. And for net present value, we are going to multiply all the cash flows with their present value, with their present value factor. So we have L3 multiplied by M3. So these are the present values of these cash flows. And when we add all these, we get net present value, which is $15,312. So this is positive. This means that NPV is positive. So company should go for the replacement, or company should buy the new machine, because in this way the company get 15,301 dollars benefit. So that's it from this replacement analysis. This the decision to buy a new machine or not depends on NPV, and hence the NPV is positive, then the company should go for buying this machine. The next topic for today's lecture is optimal capital budget. So, it is the total amount of capital or funds a company should invest in new projects or assets to maximize its value while balancing risk and return. It represents the ideal level of investment in project that meets or exceed the company's required rate of return, for example, WACC or weighted average cost of capital. So this means that the project's return should be higher than the company's required rate of return, or you can say higher than weighted average cost of capital. By selecting projects with positive NPVs and high potential for return, the company can effectively grow its value without overextending its resources. So, this is the concept behind optimal capital budget, and what are the steps involved in calculation the optimal capital budget, or in preparation of the optimal capital budget. First, we need to determine which project should be accepted based on their IRR as compared to WACC. So, I have mentioned earlier that IRR of the project should be higher than the company's weighted average cost of capital. For this, companies consider two most important factors. Number one, marginal cost of capital schedule. So it represents the cost associated with each raise in the company's capital structure from various resources, maybe from equity, maybe from existing retained earning, maybe from issuing new shares, or maybe from issuing debt. So the marginal cost of capital represent the company's capital structure from various resources, and this rate increases with each unit of capital raised by the company. The next thing which is important, or the next factor, is investment opportunity schedule. It represents a list of projects sorted descending according to their internal rate of return. Sorted descending means the highest return should be ranked first, and then the second highest, and then the third highest, and so on. So investment opportunity schedule should also be prepared while calculating or computing optimal capital budget. Now consider both factors, that is the marginal cost of capital, which is WACC, and the opportunity schedule, which is IRR. Uh, so exclude those projects where IRR are less than WACC. As we have discussed here, that consider only those projects whose IRR are, or those returns are higher than weighted average cost of the capital. And then also select the project according to the available finance, because we know that finance is a limiting factor. So generally the projects are also selected based on the capital available. So we have problem 12-5 from the same book, Fundamentals of Financial Management, by Brigham Houston. So you can see that here, this is the problem, and the company estimate that its WACC is 10% if equity comes from the retained earning. So here, if equity comes from retained earnings, then the weighted average cost of capital would be 10%. And if the company uses to issue new stock to raise new equity, then it estimates that the WACC will rise to 10.8%. So if equity comes from issuing new shares, then the weighted average cost of capital would be 10.8%. Okay. Then, so these are the two ways the company can finance its new project. The company believes that it will exhaust its retained earning at 2.5 million of capital due to the number of highly profitable projects available to the firm and its limited earning. So this 2.5 million of capital is limited if the company is going to use its retained earning to finance the project. So in the first case, if the equity comes from retained earning, then the finance is limited, which is $2.5 million. So, the company is considering the following seven investment projects. Uh, these are the seven projects, and these are already in descending order, showing the highest return or highest internal rate of return first, and then in the rest of them are in the declining order. And the size of the investment is also here, that project A required $650,000, project B required $1,050,000, and so on. So these are the investment required by these projects, and their internal rate of return are also here. So assume that each of these projects is independent and that each is just as risky as the firm existing assets. So which sets of projects should be accepted? So this is the first part of the problem, that which project should be accepted. As we have discussed in the slides, that those projects whose IRR are higher than weighted average cost of capital, so those projects should be accepted. So in this case, weighted average cost of capital is 10.8%. So now we are going to select those projects whose IRR are more than 10.8%. So you can see that project A has 14% return, B is 13.5%, C has 11.2%, D has 11%, whereas E, F, and G has return which is less than weighted average cost of capital. So we are not going to consider these projects because these projects are not profitable for the company as compared to its uh, cost of capital. The next part is what is the firm's optimal capital budget? Now we are going to prepare firm's optimal capital budget in the next step. So the first thing, if equity comes from retained earning. So if equity comes from retained earning, do remember that we have limited capital, which is 2.5 million. So in this case, we can finance only project A and project B because uh, you can see the size of the investment. In case of project A, it is $650,000, and in case of B, it is $1,050,000. And when we add both of them, the total amount of investment is $1.7 million. Suppose if we add project C also, so the project C investment is 1 million and the total amount of investment which is required is 2.7 billion, which exceeds from this limited capital, which is 2.5 million. So we cannot consider project C if we finance only from the retained earnings. However, we have another option, and the other option is we can finance these projects from issuing new shares. Issuing new shares. So if we finance these projects from issuing new shares, we can finance all four projects whose IRR are greater than weighted average cost of capital, which is 10.8. So in this case, you can see that we have project A, then project B, then project C, and then project D. So the amount or the investment required in project A is $650,000, then 1050, then 1 million, and then 1.2 million. So when we add all of these, then the amount would be $3.9 million is required. So company has two options. One is the company can finance these projects by retained earnings. So retained earning is limited. So company can finance only two projects, project A and project B. And if the company opt to finance from issuing new shares, then company can finance four project A, B, C, D, because their IRR are higher than the weighted average cost of capital. However, if we prepare optimal capital budget, then the company can go from, we have finance from retained earning, and we have, you can say, finance from retained earning and finance from issuing new shares. So, if equity is sourced from retained earnings, the company can only fund two projects, which is A and B, due to the limited funds available from retained earnings. And you can see that if the company chooses to finance these projects through new shares, then it can invest in all four projects. But if we want to create an optimal capital budget, a company should allocate 2.5 million from the retained earnings first, and then issue new equity for the remaining 1.4 million. This approach takes the advantage of lower cost of funding through retained earnings and making it more affordable financing option. Since the new shares is more expensive than funding from retained earning. You can see that new shares or the cost of new shares are 10.8% and the retained earning cost is 10%. So company should finance first from the retained earning in order to fully utilize its internal equity before issuing new shares. So if why? Because if it aims to invest in all four projects. So we have uh, all four projects. These are all four projects. Now, the company should use retained earning to fully finance project A, which is 650, then project B, which is 1050, and then in case of project C, the company has only 2.5 million in case of retained earning. So uh, you can calculate the remaining amount. Here we have, by adding these two, it is just 1.7 million. So we deduct 2.5 million. So the remaining fund is 800,000. Here we have $800,000 because project C's total investment is 1 million. So company should utilize its internal funds first because of the less cost or lower cost of funding. So the remaining amount is dollar 2 million, which company can get this amount 2 million from issuing new shares. And then the remaining D, project D, which is the total investment is 12 million. So here you can see we have optimal capital budget. In this case, uh, company first utilize its internal equity because its cost is lesser than issuing the new shares. So if the company's option is to finance all four projects, then this is the optimal budget. In this way, here you can add these equity as well. So all four budgets required total $3.9 million. So first company utilize retained earnings, which is 2.5 million and it is limited. And then company go for external equity, which is by issuing new shares. So company required 1.4 million. So this is the optimal capital budget. In this way, you can say that the company fully utilized its equity before issuing new shares. Why? Because in this way, the company takes advantage of lower cost of funding through retain earning first and then issue new share for the remaining 1.4 million. So this is the optimal capital budget, and that's it from this problem. Take care, class.